Thanks, Simon. Good afternoon, everyone. Great to be back again. I thought I'd talk about some technical elements today because my first hour we did mindset, and last time we did some key elements of risk management. And I'd like to get to a point where I could actually we could get to a live session. I can show you some of these in more detail. But we do have something interesting happening right now on the charts, based exactly on what I'm going to be showing you over the next hour. So we should get a chance to go and have a look at that as well. So what I'm really doing here is I'm going to spend 40 minutes or so just talking about 5 or 6 key technical lessons that really I've only learned, or not just me but the team, because I've asked the team for their input as well, that we've only really learned on the job. So there is some element of theory to this, but there's also some key points that we've learned from actually trading for real and seeing different scenarios and seeing different market cycles as well. So when I say, what do I mean by technical lessons, I'm essentially talking about your technical analysis, so your analysis focus. So rather than your fundamentals, more about what's going on from a charting perspective. So whatever trade I'm placing, so whenever I'm trading, there will always be a percentage of chart analysis involved. And in fact, most of what I do is chart analysis. I'm a technical trader by profession. And a lot of this time I'm doing this with my students in our live online trading room. So before we ever place a trade, there is a whole series and a whole process of analysis that's done to make sure that when we place that trade, we're happy with that trade. Not from the perspective of we place this trade, it's going to win. And this is something I'm going to talk about today, but are we happy with the technical process? And as a result of refining that technical process, not just my own, but other traders who are trading different setups, different strategies, different time frames, there's some key things that have come out from that. So I'm going to get cracking straight away and go in with lesson number 1, and I am going to jump in and out of my slides and over to the charts as well. So there may be a little bit of jumping around, but I think it's important. So lesson number 1, there is no single technical tool that is the best. So I get asked this a lot, I think more so from new traders, but what's the best technical tool? And there are certainly processes that are better than others, but from what my experience, there is no one technical tool. So RSI isn't better than the money flow, or MACD isn't better than stochastics. I think it's very dangerous to start pitching one tool better than the other. However, in terms of priority, which we're going to talk a little bit about shortly, there are some tools that I think essentially live above the others and should be your priority. But if you come to me and say, well, what's the best indicator, what's the best study, what's the best tool, is Fibonacci better than moving averages? You're not going to get an answer from me that says, yes, you must go and use moving averages, they're better than Fibonacci. That really isn't the way to go. And one of the things you'll find over time is that in a lot of scenarios, you'll get one particular indicator that you use, and it'll have a period or a tool. So it might not be an indicator, it could be a certain type of support and resistance, or it could be something like Fibonacci, and you'll have a period of time, and I think this is the key distinction, where it works very well. And the difficulty with regards to something working very well for a period of time is it's very easy, if it works well, to think it's now the best, or think it's now going to work that way forever. And then what you'll tend to find is when your tool or your particular strategy that uses, say, Fibonacci doesn't work as well, your colleague, your friend, your trading buddy, or somebody that you know will be using a different tool, and it will just so happen that their tool is working well, or their indicator is working well at the time. And that's where the risk is, that I see too many traders jumping around or starting with one particular indicator, then the next minute they've got 4, and then 2 weeks later they're back down to 2, and then they've changed again, and they're forever chopping and changing. And there is a subtle difference between refining your process and adding and taking away things from that process than jumping from pillar to post. Because a lot of traders simply don't just give the strategy or the technical setups that they're looking for, they simply don't give them enough time or trading with the right risk to see whether or not they've actually got any strength over a period of time. So lesson number 1 is there's I would say no single tool that is the best. And I'm going to give you some specific actions that you can go and take away with or start looking at in terms of your own trading. And the first one would be this: choose one technical tool, and I'll talk to you about what different ones you can look at. Choose one first. So build it like a set of building blocks. and then go away and see if that particular tool, so whether you say, right, I'm going to start using moving averages on my trend-based trades, or I'm going to use Fibonacci on my trend-based trades, rather than pick both, just pick one and look at that individual one and see whether or not by adding it to your trading strategy or trading process, does it give you an edge? If it gives you an edge, great, go with it. And then if you're going to bring in something else, you can do that slowly, but start with one. Too many traders will create a chart that's littered with pivots, moving averages, Fibonacci's, RSI's, MACDs, and especially in the early days, there's too much to look at and it's too much to take in, and quite often you can talk yourselves out of trades when you've got too many indicators, or also you can lose the process by having too many steps within it. So start with one tool. If it gives you an edge over time, go away and test it, then work with it. You don't necessarily need lots of different technical elements to be able to make a successful trading strategy. And this leads on to lesson number 2, which is more indicators doesn't give you more certainty on your trade. It can feel as though it does. So I see this a lot with, and I made this mistake myself, and I see this a lot with new traders, is they'll layer up a chart and they'll come to me and say, right, I'm looking at a particular trade, it's reached this level, it's got this, and they start reeling off all these things that intertwine at that point. And it may be that over time, so over a period of 100 trades, having that particular setup with that many criteria behind it, that shows an edge, and it shows a better edge over 100 trades, or shows a better edge over a period of a year or 2 years. But in that individual trade, that doesn't give that trade any more certainty, because essentially at that moment you're in the thrust of whether or not that trade is just going to simply go your way or not go your way. So it's something I see a lot, is people go, I've got so many things lining up here, the trade has more chance of winning, and it's a trap you don't want to fall into. And if I just quickly jump to my charts, you'll see this here. So if we have a look at my charts, just bear with me 2 seconds. So if we look at my charts, and I'll come back and I'll add pivots, so I want to layer some indicators on here. So if we look here, you'll see, looking at this particular market, that I've got my candles, I've got RSI, and I've got a series of moving average lines just there. So Simon, can you just confirm that people can see this, or at least you can see this? So you can see all I've got here is the chart itself, candles, a series of moving averages, and I've got RSI. So in essence, I'm working with about 3 or 4 tools on top of the candles themselves. So I'm using support and resistance, which I'm going to talk about in a second. I'm using moving averages, and I'm using RSI. And the RSI is specific to the particular strategy that I'm looking at, which again I'll talk about very shortly. So I've not littered my chart with tons and tons of indicators. You did see pivots on there a second ago. I will talk a little bit more about that. But I see chart after chart, I see people have too many things on there.
Great. Could you just reiterate the various lines, or a couple of questions come in? Yes. What's the blue, what's the orange, etc. So
okay. Yeah, so I use a very simple process. I'll go from short term to long term. So I've got the 8. I'll ignore the 2 black lines just there. I've got the 8, the 21, the 50, the 100 in blue, and then the 200 in red. So I'm using a series of moving average lines from stronger to weaker, and then I'm using 2 moving average lines as bands here that you can see here, those 2 black ones. So in essence, I'm using one, if you think about it from a focus point of view, my main type of study or indicator that I'm using, oh, I just changed the pen. The main one I'm using is moving averages. So that's number 1. So I'm using moving averages, number 1. And that is my, in terms of the tools that I will use, that is my priority, that is my number 1 focus. And then down here, you can see I've got the RSI. But this is a distinction that I'm going to talk about in a bit more detail as we go through, but I'll make the point now, is that when I'm using something like RSI, this is specific to the particular strategy, and you'll understand this as I go through the session. I don't use the RSI all the time. The RSI is on this particular chart because it is specific to the strategy. However, regardless of the strategy that I trade, moving averages are my go-to, for want of a better expression. Different traders have different ones. I've got friends who use moving averages. I know other traders that will use Fibonacci as their go-to when they're looking at a trend move. But for me, I prefer to use moving averages. But that doesn't mean it's the best. Somebody else could be perfectly happy using Fibonacci, perfectly happy using something completely different. So that's my focus. So you've got the 8 there, there's the 8, there's the 21, there's the 50, there's the 100, and there's the 200. So I'm using quite a few moving averages, and again, not on every single strategy will I use all of these, but these are the ones that will sit on my chart, and I'll explain the context of why I'm using them very shortly, because I use them both within my strategy, but I also use them within my discretion as well, and I'll come to that very shortly. Does that clear that up, Simon? Does that make sense for everyone?
Yep, thank you very much.
Great. So, second action to take, which is very much in line with what we have already been saying in terms of lessons. Second action is only add in further technical tools. So only add in an RSI, or only add in additional, I don't know, Fibonacci's alongside your moving averages if they improve your edge. So there's no point. A lot of people will put more tools onto their chart because they feel like it's giving them more certainty, or they feel like they've got a better chance of winning on the trade if there are more reasons for that trade to be taken. But really, it comes down to your edge. It comes down to the result over a period of time. So only add something on if it improves what you're doing over time. So that's the second action I want you guys to think about. Don't just simply keep adding stuff onto your chart thinking this will make you better, this will make you better. Only add stuff if it improves your edge. And the only way you're going to know that is you're going to have to test it both real time with your trades going forward and potentially back test that as well. Then number 3, I think as an overall key process to have in your mind. I've said there's no one best tool, but for me, the price action will trump any form of indicator. So in terms of a priority, both in terms of my process and in terms of what I value, if somebody said to me, okay, Ali, you can only use one process or one tool or one technical method and all the others were not allowed to be used, I would use support and resistance. So support and resistance would be my top one. So anything trend based, anything support and resistance based, so anything price action based, I would use that. Now for me, when I talk about price action, you can include candle patterns. I don't use a huge amount of candle patterns. I'll use, again, candle patterns dependent on the strategy that I'm trading. But for me, if I had to say which one thing would I use, then I would say price action. I'm going to explain how that works with a trade that we had very recently. And if you hear me talk about studies, we at Trader Support Club phrase a study as something like a moving average or a Fibonacci, so something actually happening on the price chart, and I'll show you this in a second, as opposed to an indicator which lives below the waterline, as you saw with the RSI down the bottom. So I'll show you that in a little bit more detail. So the example we're going to take is from one of our signal service trades that we had earlier on in the month. So you'll see here on the screen, I'll just put a circle around it, we're going to look at a trade setup that we had on New Zealand dollar yen. Now, these signals come out. We don't tell people when to buy or sell. So it's not a signal service where you get a flash up on your screen saying buy or sell. We want to teach you actually how to take the positions. But the possible trades that we're looking to take go out on a possible list. So we're going to focus on this one that went out, I think it went out slightly earlier than then. It was a couple of days before that, but it's a possible trade on New Zealand dollar yen. Now it has gone on to win. We had a couple of winners on these yen pairs, but I'm going to explain to you those technical tools and the actions to take in relation to an actual trade. So we're looking at a short trade. The specific strategy is what's called an SCBO. It's called a swing consolidation breakout. But the strategy specifics are something different to the technical tools that we're using, even though the technical tools can be part of those specifics. And you'll see this as I go through. Let me just get rid of all this. So we're looking at New Zealand dollar yen just here. So can you just check, everyone? Can you just let Simon know that you can see my screen, because it's important that I can show you this and this all works. So if you think about what I've said already, that price action will trump indicators for me. So the first thing that I'm going to do in my process, regardless of what type of strategy, what type of trade, is I'm going to look and see where, and the key word here is where are my key levels. So the first thing I'll start with is price action. So if I'm looking to trade on a specific time frame, I'm always going to look at the price action above that time frame. So if it's a daily chart that I'm looking to trade on, I'm going to look at price action ahead of the potential trade on either the weekly or the monthly. If I'm looking to trade on a 5-minute chart, then I'm going to look at the price action on a 60-minute chart ahead of the potential trade. So the keynote that I want you to write down here is the reason you start with price action, which is your next action to take. You'll see this here. So the next action to take is start with price action, so support and resistance lines and trend lines, is by doing that first, you can already start to get an idea of where you want your particular setup to occur. So if I just end the show now. So if I go from this daily chart, and obviously we can see the result afterwards, but you saw the email going out when price was all the way up here. So the email went out when price was about there. So if I was to go up to my weekly chart here, back at that point, I can see that I've got a very, very specific area of support and resistance. So if the action to take is start with price action, and price action is support and resistance and trend lines, I can see a key area of previous resistance where I've just drawn that blue line in. So can I just have a little bit of feedback? Can everybody see that area just there? So we've got prior highs just here. So we've got the 2017 highs, the 2016 highs, and we've got that area close to being tested here in terms of the highs late in there, and we've got some previous areas just in there as well.
Yeah, we're getting yeses through, Ali. Thanks.
Excellent. Perfect. So for me, whatever trading strategy I'm trading, whether I'm trading with or against the trend, that area is still significant to me. So for me, I'm already letting the market, or letting myself know, letting the students know, or even letting the market know in terms of my intention, that I'm not going to consider any type of trade with the trend when we're close to this level, because we're moving into it. But I would consider, if we got into this level, an against the trend trade. So the only way I can do that is by defining my levels. So the first thing I'll always do is decide where my levels are, and this is irrelevant to moving averages. This is irrelevant to RSI. And then what I'm doing is I'm saying to the market, this is where I will consider a trade. Doesn't mean I will trade there, it's the area where I will. So very simply, I can see that last time price was here, back at the start of 2017, we made a move down. Previous time, we made a move down. Previous time, we made a move down. Now, there's no guarantee that that's going to continue. We understand that. But going on previous history, previous price action, in that scenario, I would be looking to look at a short trade. So I have to have a strategy within my strategy toolbox, within my process, that would allow for something like that at that level, which we do. So first rule is start with price first, and the additional rule is start on a higher time frame than you're willing to trade, than you're actually going to trade on. So the analysis is done on a higher time frame. So now everything that I do is all about waiting for price to reach that level. Now I can start preempting what I'm looking at, what I'm wanting to do, and I can start preempting that ahead of the trade coming along. So this is where number 4 comes in. So we're going to scroll this back and we're going to follow this through in a second, but I'm going to pull up the chart. I'm going to pull up the slides again, because this is where lesson number 4 comes in, which is using the right type of technical tool or technical tools for the right type of market condition. So please make a note of that. It's really important, and I've learned this over and over, that it's easy to use the wrong indicator at the wrong time, or to be using so using a with the trend indicator when I would be looking at an against the trend trade, or using an against the trade indicator or a range bound indicator when the market is trending. And this is simple stuff that you can read in a book, but quite often the simple stuff, once you go and apply it, you start to realize that it actually makes sense. But the key is what and where. So if we go back to this market and we look here, we can see our previous resistance. It's the top blue line. Okay, so I'm going to get rid of these two for now. So we can see the previous resistance right up there. So I've already said to the market the price action comes first, support and resistance. The only thing that I've got to acknowledge here is the trend. So really simple, we're going to pop the trend line on through here. So there's my trend line. So that I can see at the moment I'm currently in an upward trend, but that trend is starting to move to an extended area. Now, how do I know that? Because I've got the right type of indicator for the right type of market condition. So for me, I'm not going to consider at this point here, when we reach this level, I'm not going to consider trading with the trend. So the only thing I'm going to consider, if certain criteria are met, is trading against the trend. Now, for me to trade against the trend, and this is something that I've learned, it's a huge thing that I've learned, is that if I'm going to trade against the trend, I don't trade against the trend because the market conditions suggest that. The key thing to make a note of here is I'll trade against the trend if the market conditions suggest that, and I have an against the trend strategy available to me. And again, this is what I see too many traders make the mistake of. So they trade with the trend, they have a couple of good trades, they're feeling greedy, and they go, right, I think this trend's going to come to an end, I'm going to short this market. But they haven't actually got an against the trend trade in their strategy. So they're using them and looking at the overall market conditions and making, you know, a predetermined assumption saying, yeah, I think the market could at this point head back down because that's what it's done the last two times. But they haven't got any tools or the right tools because they haven't built a strategy. They're just making that decision that they're going to short at that level because they've seen the overall conditions. So the overall price analysis that you do first is great, but you've got to have the right technical tools, i.e. strategy, the right strategy for those market conditions, which is what we have. We have what's called a swing consolidation breakout, that when the market is in extended territory, you don't simply short the market up at the highs. I know some traders, and we even have an intraday strategy where you short at highs or you go long at lows. So it's quite an aggressive entry. But what we're looking for here, can everybody see that at this point here, with this red candle, that price has now broken the trend line? Give me a yes if that makes sense. So just let Simon know that you can see that.
Yes, we're getting a yes.
So we've got to break the trend line. So the right technical tools and the right technical setup are in relation to what I'm doing. So if I'm going to go against this trend, so this trend is up, I need to, one, have done my price analysis first and know that where we're looking to go against the trend, there is some historical evidence to suggest that. We've got that there. And we know that we've got that level goes even further back if we were to scroll that up, because that's the daily chart. We were looking at it on the weekly. I can also see that this trend line's been broken for the first time since the trend began. So I'm looking for a trend line break. And I can also see that I've got a period of higher highs coming into that previous level of resistance, which is met with lower highs on the indicator. Now again, that's no guarantee that we're going to see a move down, but what I'm using is I'm using the right type of technical tools for the type of trade that I'm looking at, rather than just sitting there, you know, thinking and sticking my thumb in the air and going, yeah, we're up at some highs, I'm going to go short. Now, had you gotten short of that resistance, it would have all worked out very well, but consistently over time with multiple trades, I'm going to want more evidence. So going back just briefly to our slides. An action to take is create a process for how and where you use price action, and then when to trade for your actual strategy, which is essentially what we're doing. So rather than just say, I'm going to go long and short at highs or lows, it's identify the highs and lows, and then decide if I'm going to trade with the trend am I going to trade? I'm going to trade within those levels. If I'm going to trade against the trend, I'm going to trade at those key levels, but then find a series of criteria that support that. So then you may only be using price action, and if I go back to my example, I'm only using a couple of things here. So if I just go back to that, I'm basically using price action because price trumps everything else. I'm using trend lines, which I've already talked about. So I'm looking for a move against that trend. And then I'm using RSI divergence. So essentially I'm only using three things. Although I've got my moving averages on there, for this particular strategy I'm not using them because I tend to use my moving averages for when I'm trading with the trend. So really I'm only interchanging between RSI and moving averages when I'm looking at the different types of trades set up. And then the actual trade setup occurs there. So the short trade that we took as a collective was there, and then you can see it worked out very well. We didn't get that entire move. Our target was down here. Now what's interesting is we used the moving average as a target. So we've seen the moving average, we've seen us break this particular level, but the 200 moving average was a target. So we didn't get the whole of the move. Our trade was from here to here. But that's a specific strategy. Your strategy might be different. If you come and get on board and use one of our strategies, one of the things that we are hugely hot on is not just taking the strategy and trading it, but understanding that you trade the strategy, look at what type of strategy it is. Is it against the trend? Is it with the trend? And start using support and resistance and getting your skill set tuned into that, so that you make better trading decisions in terms of the strategy criteria. Because what's happening here is just a set of tick box criteria. It's not complicated, it's not difficult. The skill is picking the trades at the right levels. And this looks, very simple, very clean, very easy trade to take. But 80% of your trades should look like that because you're finding the right setup at the right time. Now, in contradiction to what I've just said, can everybody see that it looks like a really nice clean move? It's come up to the high. Can everybody see that it's one of those trades that looks great, doesn't it? It's coming to the level, done exactly what you want, yeah? Well, I think it's really important from your perspective, and the more experienced traders will get this, and the less experienced traders, I think it's important you know this, is you need to manage your technical expectations, and I'm going to explain what I mean by that. So it's easy when you look at a trade like that, and when you've had this month, so we had that trade was 3.5%. So most of our swing traders, we've had 3 winners and 1 loser. So I would say most of our swing traders are up about 8% this month on the signals that have gone out. So it's a fairly nice month for the swing traders. Not been so great for the day traders. But the swing traders have had a good month. It'd be very easy if you were to look at just this setup and I was to pull up the other ones from this month to go, this type of strategy works every time because you've seen it work 2 or 3 times. And we as human beings tend to do something where we think short term. What was interesting listening to David just prior to coming on is he's showing you stuff from way back. He's showing you stuff from 2000, and he's getting you to think about things over a longer period of time. People at the moment are forgetting that we had a recession in 2007 because we tend to think short term, and the way we operate in society at the moment, we're very quick. Things we can get things quickly. You can get a book on Amazon in 2 seconds. So it's easy to bring your time down to a very small fraction, and you have 2 or 3 trades that look really peachy, set up really nice, set up cleanly, do exactly what you want. You get a nice 3-to-1 on the trade or a nice 4-to-1 on the trade, and you think it's always going to be that way. Whereas you're going to have times where you're going to get a setup that technically looks great. You've got a really nice resistance level or a really nice level of support. All your criteria are met, and then the trade's just going to go the other way. Because one of the things people do, and this is, I think, lesson 5 in terms of managing your expectations, is realize that just because a level is clean and just because price has bounced off it doesn't mean that every single time it's going to do that. Or even 80% of the time it's going to do that. It may only be 60-70% of the time. Because when you look at support and resistance, a lot of the time people are only factoring in where price has been. They're not understanding that at times price can smash through that level because in that moment there is an increase in momentum, there's enough buying to push it through that resistance or enough selling to push it through the support. So it's important to manage your expectations. Any type of technical strategy, technical process, technical methodology is not foolproof. It will have periods of drawdown or it'll have periods where it averages out, and that's when the skill as a trader is to stick to it. So it's not really a technical lesson per se, but it's almost a mindset lesson within your entire technical expectation, which is to, within your technical process, is to manage it. It's very easy after 5 or 6 trades to get hooked in and think what you're doing is going to work every single time. So just go back to the rules here, or the actions. So remember both sides of the analysis coin. Yes, your analysis can look great, can look clean, it follows a process, but on that day the market could just choose to go higher, or that day the market just choose to go lower. So always bring that back to a level of perspective. Now, this is actually, I put the message out to the team and I said, guys, is there anything that you'd like me to share with everybody today? And this one comes specifically from James, one of the team members. He said, don't get drawn into one time frame. Now I'm going to talk a little bit about this now, and actually what's fascinating is this was happening real time. So prior to me coming in, I was actually seeing this happen. So I'm going to switch completely down from a daily time frame. I'm going to go down to a 5-minute chart here, and I'm going to pull up the pound against the US dollar, which is a market that I trade on a regular basis. That's one of my main day trading markets. So I'll just go to pound US dollar. And we'll come back to what's happened in a second. So I'm going to need a little bit of feedback here from everyone. So if we look at this time frame here, this is the 5-minute chart, and this was about, when was this? This was coming up to 1 o'clock. So this was just prior to me coming in this afternoon. Can everybody see that this market here on a 5-minute chart, so pound against the US dollar, you can see here that the market is broken out of what looks like the overnight lows and has made a couple of higher highs and has just made a new higher high just here. So price looks as though it's cleared out the overnight highs and wants to go higher. Not saying it will, but can everybody see that?
Yes, I can see that. Yes, we're getting some. Yep, yes, it's coming through.
Brilliant. So the trap I've seen new and intermediate traders get into is that they have a certain strategy that sets up on a certain time frame, so a set of criteria, and I have that for my 5-minute trades. But this is why point 3 about starting with your overall price action, so your overall support and your overall trends, is so important, because it's easy to get locked in and transfixed by what is going on here. And you think, excellent, we've got a new high, and then if X, Y, and Z happens and I get my pullback to the prior highs, I haven't had a trade all morning, it hasn't quite worked out, or I went out this morning, missed a trade, and now I'm come back, I haven't had a trade for a couple of days, I'm feeling greedy, or I've had a couple of losers, I want to get my money back, and all the emotions start to kick in. It's easy to get transfixed on this and either forget to go and look at the higher time frames, or just decide you're not going to bother because you want that trade too badly. Whereas what's really interesting here, and these are the screenshots that I was taking literally just before we came in, so I'll just get rid of all this. So if I actually come and show you the next one, if we look at the 4-hour chart of the same market at exactly the same time, can everybody now see that if I look at this 4-hour chart, I've actually got an area of resistance from here that is acting as a support, and I've actually got 2 lines in here, and I've also got a moving average in here. So as soon as I'm on the 4-hour chart, if I look at the 4-hour chart, the 4-hour chart's trend looks completely different. And actually what we've got here is we've got a new low, and we've actually pulled back into an area of resistance. Can everybody see that? So because of me getting transfixed on the 5-minute chart, instead of coming out and looking at the bigger picture, as James has suggested as one of his key lessons, is what I've missed if I don't go and do that. And the reason why I said start with price analysis first is you should already know about this, so it means you don't get hooked into the trade. Because the problem you've got is this: if you then sit with that trade, you sit with it and you watch it and you watch it and you watch it, and you haven't gone to the 4-hour chart like you can see here. If you sit with that trade and sit with it and sit with it, and then it goes a little bit higher and you didn't have the support and resistance lines on, this is what happens. You start to see your setup and it gets tempting. And then if you get the candle pattern you want in your direction, look, it gets even more tempting. So at this point here, I could be either naively trading this because I haven't realized there is higher time frame support and resistance, or if I haven't done that work up front and I come to look at the charts and go, right, it looks like I've got a trade, and then I rush to the higher time frames, it becomes very difficult not to take the trade. Whereas I've already made the decision, and I made that decision way before 1 o'clock, that I won't be trading this, and I won't be trading it because of where we are. So if we get into this zone here, I'm already switching off because I'm not going to trade with the trend when we've come into an area of support and resistance. Now, would I consider a counter trend trade? Not as a day trader, because that's not my strategy. I only counter trend trade as a swing trader. So the key thing here is by starting with the price analysis first and going to the higher time frame. So this is my lesson, my learning, James's lesson. I saved myself the issue. Now what's interesting is, let's go and see what actually happened. There you go. So price, there was the tempting bit that I was talking about on the slide. Price came up, and even if my target was there, my first target was the previous high, look, it didn't make it, came down. Now you could argue, you could say, well, hang on a second, Ali, it could have easily have broken through the other way. And then you'd be sitting there going, oh, missed a trade. No, you haven't missed a trade, because I decided I wasn't trading before any of this had happened. So the fact that it's gone my way here just makes me look good this afternoon. It doesn't always do that. I can make the decision not to place the trade, and it does that. But I become way more comfortable with my decisions if they're based on a higher time frame and they are based before the setup comes along. I would much rather be out of a trade wishing I was in than in a trade wishing I was out. So the fact this has worked to my favor. The decision to not trade this has worked in my favor, but my decision to not trade it is not because of the hindsight move. It's because when I'm at a support and resistance zone, I'm not going to trade with the trend. So that's one of the key lessons. So I think it's great that James has brought that in, because the higher time frame really has assisted in that scenario.
All too easy to get caught up in the moment. It's a good lesson, that.
Yeah, very much so. Right, where are we time-wise? I've got about 15 minutes. So there's a couple of other things I just want to cover. Now, in terms of the process that I use, different people use different processes in terms of what they do, but the one rule that we have at Traders Support Club is everybody does their overall price analysis, regardless of the strategy, regardless of the time frame. They do that before they ever consider a trade. If you're getting up and you're going straight in and looking at your strategy time frame, be it a daily or a 5 or a 60, and then you're working back, it's a dangerous game. So I think the action to consider here is start top down. So well, however you trade, start top down. And I even bring this in from an investment point of view. So looking at Bitcoin and looking at these scenarios, everyone's getting excited about it. Should I get in? Shouldn't I get out? Has the bubble happened? Has this happened? I would look at anything from a top-down point of view. Exactly what David was showing you. People think investing and trading are so different. Yes, you're primarily looking at fundamentals if you're looking at investments, but the top-down analysis, the bubble analysis, all of that is exactly the same in terms of its principle. So if I'm swing trading and I'm placing a trade on the daily chart, so if we essentially go back to my daily time frame and we go back to that New Zealand dollar yen trade, if I just pull that up now. So if I'm looking at this, I'd already, as you know, I'd already done my higher time frame analysis and said I will trade short here. I'm not going to trade a pullback because it's too close, just like I didn't trade a pullback on the 5-minute chart this afternoon. But if the right setup comes along, I'll trade against the trend. So the way I can do that is start top down. And the other benefit from top down analysis is you can start to swing trade 40 markets quite easily, because you don't trade 40 markets. You may only be trading 2 or 3, but you only markets you follow for the next 2 days or the next week are the markets that are close to the level. So if you start with price action, you have a process, you won't have to look at 40 markets on a daily basis. You'll only be looking at 5 or 6, which is why when you look at the email that we send out, there's only 3 or 4 potential trades at any one time, because we're listing them in terms of the ones that have got the best overall price action. So as I've said, start top down always. Then here's a little interesting bonus from the team, and I think this is funny. So I sent the team a little WhatsApp message asking them what their kind of biggest technical lessons were, and they all fired them back in quick succession. So Kerry, she said, I guess allowing wiggle room stands out for me. Now what she means by that is she means rather than treating a level of support and resistance as an exact science, as an exact level, she will look at support and resistance in terms of an area, and she'll also consider that when she's placing trades. So she'll always allow, as it says there, plus or minus points at her levels, entries and trend lines. Adding that to my discretion has helped to avoid a lot of losers. So essentially what she's saying is if I can see that I've got a pullback trade like this, I'm not simply going to use and say, right, there's my entry. I'm going to give my entry some wiggle room either side. And if I'm using a stop, say down here, and the target up here, I'm going to give my stop some wiggle room as well. So that's a really good one. And Martin's put here, which is really interesting. Martin has said, to me, identifying support and resistance more as areas than a specific price. And then Kerry said, exactly, Martin. So thinking of those levels, be it trend lines or support and resistance lines, as zones rather than finite. And then Sally has said here, mine is the basics of trends, good old-fashioned support and resistance is always always central to my technical trading, no matter how sophisticated. So this is exactly what I've been saying about start with price action. So I'd already done most of my slides before I asked them this question this morning. I just find it fascinating that we all come through the same answer. But then when you stop and think about it, if there is a process that works as a general rule, regardless of the strategy you trade, because these guys all trade different strategies over different time frames, if there's an overall scenario, then they'll work to that. And she said the same thing. Think of support and resistance as a zone rather than an exact level to the point. So to summarize, here are some different actions or things that you can think about or add in to your trading. So number one, choose one technical tool that you're going to add in or use or test first. Don't pile in with 5 or 6. Try one, see if it gives you an edge, and then only add in if that edge is improved. But there's something I just want to add in here. I've seen traders add in, like using 2 or 3 technical tools, so let's say moving averages and MACD for momentum-based trades, and then they add in another indicator, and then they add in something else and something else. And what they find is the results on paper by adding more indicators gives them a better result. But when they come to actually physically place the trades, there's too many things for them to look at once, and the basic analogy is that the strategy works, but they can't work it. So be wary of that as well, as you might have to claw something back because it looks good on paper or you like the look of it when you're testing it, but when you actually physically come to place the trades, it doesn't necessarily work for you, so bear that in mind. I think my most important one, although it's number 3, is start with price action, support and resistance and trend lines first, and make a note next to that, start on a higher time frame to where you're actually going to consider the trade. Create a process for how, so have a process for how you do that. So start on the weekly, look at your resistance areas, look at your support areas, look at your trend lines. Find those levels where you would consider a trade. If you trade against the trend, that's great, you wait for price to get there. If you trade with the trend, you trade in between those levels. And use price action, as it says, and then wait for your actual strategy to set up, and make sure you have an actual strategy so it's something you can measure. Remember both sides of the analysis coin. Don't get sucked into thinking because this level's been bounced off clearly for the last 3 times, the 4th time is guaranteed or more likely to do that. That trade in its individual basis will do whatever it's going to do. Start your analysis top down, and as the guys have said here, as a kind of collective, think of levels as an area, not an exact point. So we'll be at 2:52. Does anyone have any questions on anything that I've covered? I'd obviously like to be able to spend more time on this, but I'd rather you guys go away with some of the action points that have helped me and the team, and that we've know have helped other students as well. Has anyone got any other questions?
It's just while these questions are coming, Arthur, that's very true. Number 7, I think it's something we've heard twice by other speakers today as well. Just to not be too hung up on the exact points of trading and charting. It does seem to feature a lot of the questions that we get. People saying, "What is the exact point I should be doing this?" and the exact level, and so forth. And it's a good point worth reinforcing, that you should be looking at the overall picture.
I've got a great quote from Bill Miller, and he says, "Certainty belongs to mathematics, not to the markets."
Very good. Yes, I like that. On that point,
another one, it's an art. Trading's both an art and a science, unfortunately.
What timeframes do you use the most, though? Wayne is asking.
Great question. So the way we summarize it, I can quickly do something here. And again, this is a guideline. It's not an exact, but the way we tend to do it, to get people to have clarity in their process, which is, to me, is the most important thing. I think if you guys make a note of that on your notes or in your head, the clarity of process is actually more important than the result trade by trade. Obviously, the result over time, you've got to be making money, but clarity of process. So we have what we call a strategy chart, where essentially most of the tick boxes occur. So using that New Zealand dollar example here, the strategy chart for that was the daily chart. So we were looking for the trend line to be broken. We were looking for a consolidation outside of the trend line for a minimum of 2 candles, and then we look for a break of the low. So I've kind of given you the strategy. That's a set of criteria. The majority of those criteria happen on the daily chart. So that's the strategy chart. My price analysis charts, so where I will decide where I'm looking, these are basically swing trades, is on the weekly and on the monthly. Excuse my M there. So the weekly and the monthly. So rather than wait for the trade to set up on the daily and then quickly go and look at my weekly and monthly and say, right, where's my trade, I will have already done my analysis on the weekly and monthly and say, this is where I am looking for one of these trades. So then it's just a waiting game. So as a swing trader, so somebody's looking, again, these definitions are always a bit here or there, but somebody who's, these trades are all taken in the evening, so the emails go out to our students. They can be getting them on the phone, they can be getting them on their laptop, whatever. They come in, they're going to be placing that trade or that order in the evening at the close of that second day candle. So they're doing that off the daily chart as a swing trader. So their price analysis charts, their discretionary analysis charts, are their monthly and weekly, and they're saying to themselves, this is where I want to trade, and then I wait for the when here. So another way of looking at that, if I am a day trader, I primarily look for my strategy to set up on the 5, but my higher time frames will be the 60, and I do have some criteria. Most of my criteria for my with the trend trades are on the 5-minute chart. I do look for some criteria. There's one criteria on the 60, but then I'm looking at the 4-hour, and I'm also looking at the daily. I heard recently, as a day trader, you don't need to worry about the daily or weekly chart. Yes, you do, because that same level that is here that you've paid attention to as a swing trader on the monthly and the weekly and the daily chart, you need to be aware of that. So as a day trader, you don't spend time sitting on the weekly or daily chart, but you still need to know where those key levels are. So as a day trader, you're looking at more levels, but your focus is going to be 60-minute for me and 4-hour, but I'm looking for the trades on the 5. Obviously, that can be different. You could be looking for setups on the 15, or you could be looking for setups on the 60, and you just ratchet it up. But there's a rule: your price analysis charts, where you do your overall analysis, you find your key levels, you decide on where your biases will be depending on where price is in relation to where it's been. You do all of that on a higher time frame to the time frame that you trade on. Does that answer the question?
Okay. Let's. That was Wayne asking that question. Is that? Oh yes, yes, great. Okay, fantastic. Richard says, have you considered using Donchians for price action as an aid for breakouts with trends instead of lagging short-term moving averages?
So good question. So in terms of, I personally haven't. I know of some traders that have. I won't use moving averages to determine when I'll get into a breakout. So if I'm looking at a potential breakout, so for example something like that, ascending triangle, I'm more of a pullback trader than a breakout trader anyway, but in theory if I'm going to trade a pullback, I need to watch for when price breaks out anyway, so I need to be aware of what's going on at this point here. But for some breakout conditions that I will trade, it's the moving averages on that time frame are not that relevant to me. It's the moving averages on the higher time frame. So if I'm looking at a 60-minute chart, where are the moving averages on the 60? So for example, if I'm in a good trend and my 60 moving averages, my 8, 21 and 50 are all lined up, all pointing up, I know statistically, based on what I've traded and what I've tested, that breakout, assuming there's nothing in the way, so there's no strong prior highs, that breakout has a better chance of working. Not every time, but over the long haul, that has a better time. So in terms of breakouts, I'm not waiting for the moving averages to do anything before I take the breakout trade, because moving averages are lagging, exactly. So for me, I haven't personally used any, I just wait for price to break a level. But again, that's something I've tested. It doesn't work every time. But if I've got moving average confluence on the higher time frames, not too high because the daily moving average momentum doesn't have so much relevance to what is going on the 5, but certainly on the 30, 15, 30 and 60 that can help as well.
Great. Okay, just another couple of minutes to get through these questions. Guy says the reason for required flexibility on entry stop levels is that most people use their support and resistance levels as their guide and not S&D supply and demand, which is more accurate. After all, supply and demand is created by the prop traders only.
Yeah, I would agree with that, but I always come from the point of view of that might be true, but look at what your testing is showing you. I'll always want to know that regardless of whether some statement of fact is given, whether it's me, whether it's somebody, whoever it is when you're taking your own trading, it's your own money, guys. So if that may well be true, but test it, because that's got to be in relation. It may be that in relation to what you do, that isn't as important, or it's not as of much bearing than if you're on a higher level. So for me, I won't place stops at support and resistances for that principle, but just because I don't place a stop at support and resistance and I use another tool doesn't necessarily mean it's going to work. I need to test that, and even if I test for 2 or 3 months or 6 months or a year, it doesn't mean the next 6 months I'll get the exact same results, which is again why we always come back to, although I've not talked about it, is risk to reward being the key factor, because whatever strategy you trade, whatever principle you use, however bulletproof it has been over a certain period of time, there will be a period of drawdown where your risk to reward becomes the most important thing, regardless of what you do technically.
Okay, Christopher, I think that might answer your question on stops as well. Don't you find that the RSI 6 gives too many false signals because it is too sensitive? Asked Richard.
Good question. I personally don't, because I'm using that diversion, that being a classic example there. And I get traders come to me and ask me exactly that. They say, oh, is RSI 6 too sensitive versus RSI 10? And honestly, how long's a piece of string? Which is more sensitive in relation to what time frame? And as boring, it almost feels like a politician's answer, but test it. So for me, this scenario here, I would not take this trade based on the fact that I'm seeing a divergence. So for me, I don't use something like, one high being lower than the other, or so for example, you could say, well, I've got divergence here, I'm going to go short. No, this is just an additional criteria, but what is more important for me is the fact that we're at that price level and that we've had a break of the trend. The RSI is the last tick in the box. So if you think about it, I'm doing my overall price analysis. I've already told the market that I will go short at this level if my strategy sets up, and I have to see the trend line break, and then when I've got my trend line break and my 2-day consolidation, that move up, all I'll do, because I've got that additional divergence down there, is I will look, assuming there's no support and resistance in the way, to run the trade for slightly longer, because I've seen a correlation between a divergence trend in the opposing direction to the last highs on price and the amount of move that you see in the opposite direction. But I've tested that. Whereas in some scenarios, you may find that if you were to do something similar, you would be better off using a 12 moving average or a 14. So I haven't found that specifically because I'm only using it as an addition to what I'm already doing.
Okay, we've just run over our time. Guys come back, so agreed, yes, exponential is the key. And he says, how important is the charting platform? Is this one you're using for analysis or is it for trading too?
Good question. I keep it really simple, and I haven't changed this much in the last, because the markets haven't required a change. I use ETX to place my trades on, so I'm using a separate broker to my charting platform. So this is Pro Real Time. I use Pro Real Time because I really like it. They give it to me free, so great. And it covers all the bases. I used to use eSignal. I moved over to Pro Real Time, and I found that it covered all the bases that I need. I think personally, charting software becomes more important if you're day trading. I could happily swing trade and use ETX free charts, and I would still be able to do everything I need. All that charting software does is speed up. I think potential speed at which you can move around charts. I think generally traders put too much weight and spend too much time worrying about charting software, and actually need to spend more time worrying about their technical process and doing 100 back tests. So I think charting software is a contributing factor, an important one, but it's not the determining factor in your success.
Okay, well, we're going to have to draw a line under the questions there. We're going over. Wayne, fantastic presentation, straight talking, right to the point, clear understanding of your strategy approach. I look forward to watching this again with recording for it to sink in. Please, could I have your email address for further questions?
Oh, yes, sorry, just quickly before, and I know I've run over, so my apologies, just quickly, because I'm just going to quickly pull up, because the offer's still running at the moment. So if I just pull this up, guys, you can find us at tradesupportclub.com, but please just write this link down, tscmember.co.uk/RTCT, and that will give you 3 months access to some of our training materials, a Thursday night coaching webinar, and some new Platinum Playbook trades and trade setups that we're going to be running. So I don't want to run too far over here, but just do that. When you sign in, please make sure that you click the button that says, just here, you can see it here, just says round the clock trader, so that we and the team know that you're round the clock trader, because we will have some additional bonuses coming out over time. So please do head to that, and you'll have a support email and you can access me there.
Brilliant. Great feedback coming in. Excellent presentation. Thanks so much to Anish. I want to say really good presentation. Thanks to Steve. Great presentation, Bernard. Fantastic. Ali, we're going to have to cut it off there.
I understand.
Thank you
My apologies for running over. Thanks. Pleasure. All the best.
David.
Thanks, guys. I'll see you again soon.
Thank you again. Bye-bye for now. There we go. Fantastic presentation by Ali Crooks at Traders Support Club. We are going to go straight over to David Paul,